From Goldman Sachs to Google, the shares dropped more than 5% after second quarter earnings missed estimates. One of the problems, a 22% increase in expenses. Investor Paul Meeks is with us now from Winsor Asset Management. He is a former tech fund manager at Merrill Lynch. Paul, thanks so much for joining us. So the profit miss came from Google spending on two things, essentially acquisitions and increasing their staff. Is it so bad to be making investments in technology and what they hope is the next big thing?
Well, obviously, the company believes strongly in their future because they added over 1,000 people sequentially. And in the past year or so, even though in the early history of the company they've been aggressive adding staff, the past year or so they have essentially pulled that in. Now, this is a company under its leadership that's always been interested in the long term versus the short term. So they obviously see down the road, particularly as we get through some of these issues that the company shares, and also this tough economic situation worldwide, that they have a pretty bright future. But also you got to consider that vis-a-vis the rest of the world, even particularly versus tech companies, this company is still growing at a very fast clip.
So in it for the long term, Paul, and you say still growing at a fast clip. Unfortunately, we have to leave it there, Paul, but we thank you for your insight. Paul Meeks joining us there from Winsor Asset Management.